For nearly 2 decades, most investors' attention was focused on the stock market. Then suddenly, central banks began raising interest rates and investors began to rethink their strategies. That's given rise to growing interest in a range of alternative investment vehicles, including CEFs, internal funds, ETFs, UITs, and commodity pools. However, until now, most of these investment vehicles have only been available to institutional investors. I'm Jane Singer, and welcome back to A Seat at the Table, where we sit down with industry leaders and innovators to gain valuable insights that will help us grow our businesses. Today we're joined by Kimberly Flynn, Managing Director and Partner at XA Investments. Having previously served as the Senior Vice President and Head of Product Development for Nuveen Investments Global Structured Products Group, Kim's leadership and dedication played a pivotal role in developing over 40 closed-end funds and raising approximately $13 billion in capital. Kim will be discussing the democratization of alternative investments that's allowing individual investors to access institutional caliber strategies, what she sees as the top emerging alternative asset classes, what investors need to consider in an investment environment where there's high inflation and high interest rates, and how alternative investments can work with ESG strategies. Making the right financial decisions starts with having the right talent on your teams. But identifying and recruiting those people can be very challenging. That's why leading companies look to AsiaNet consultants to help them find top talent and fill even difficult-to-fill roles. With over 3 decades of experience, AsiaNet Consultants has an extensive network that gives their clients a competitive advantage in executive recruitment. To find out more about AsiaNet Consultants, check out their website at asianetconsultants.com. That's asianetconsultants.com. I'll also leave a link in the show notes on our podcast website at seat.fm. That's SEAT.fm. FM because it's a podcast website. Now let's sit down with Kim and find out about alternative investments. Kim, I'm really happy to have you here on A Seat at the Table. I think that what you're talking about with regard to investment is really timely right now because a lot's happened in the market. And I am not an expert even close to on investment, but even I know that something's going on, right? Higher interest rates, inflation. There's just been a lot of stuff that are making people rethink their strategy, so to speak. So I think a lot of people listening in all the countries we reach, I think it's 132 right now, are probably having the same questions as to what do I do now, right? What should I be looking at?
Absolutely. I think that investors who have traditionally invested in stocks and bonds in 2022 really started to rethink their asset allocation mix, and alternative investments are an area that are growing, and at least in the United States, there are new products being developed that allow individual investors to get access to types of investments such as private equity or venture capital, private credit, and real estate. These are areas of investment that pension funds and endowments have long been investing in. But if you think about the burden that we have to save for retirement as individual investors, and it's really on our shoulders to be doing the most we can for diversification. And frankly, in the US, investors are heavily over allocated to US stocks. We see a tendency to avoid even investing internationally. You mentioned that your podcast has this large footprint. I would suggest that the individual investor in the United States doesn't nearly have exposure to what the world has to offer. And so, not only should investors consider more than just US stocks and bonds, alternative investments, which tend to be less correlated or even uncorrelated, just meaning that the return profile when stocks are up, maybe real estate is down or vice versa. And so you want investments in your portfolio moving in different directions so that over time you can achieve a target return that's going to meet your objective. Maybe you're saving for a new home purchase. Maybe you're saving for retirement. So alternatives are really where there have been a lot of conversation about how do individual investors get access today.
Right. I think that's really interesting because we haven't discussed that a lot before, right? That wasn't even available. Now, you talk about the democratization of alternative investments, right? So that, as you're saying, that individual investors can actually access these institutional caliber strategies. How do you do that, right? What does that look like?
Well, in the US, usually individual investors have had some exposure to alternative investing already. And maybe that's in the form of real estate purchases or farmland purchases. So we find that real estate and real assets are often gateway alternative investments to a broader array of these types of alternatives. In the U.S., there is a registered fund. It's not a mutual fund that everybody's familiar with, but there's a type of fund called an interval fund, and it's got the same protections of the 1940 Act, meaning it's got a fund board with oversight protecting shareholders. It also has things like transparency, and investors get 1099s instead of a K-1, which is a tax form that's associated with private funds. And so historically speaking, alternatives were really only available in a private fund format. But in the last few years, we've seen a lot of both traditional investment managers and alternative managers move into this part of the world, which is more the registered fund space. And it's important. Registered just means that the SEC is reviewing these products, and that's what makes it more broadly accessible by individual investors.
Right, right. I think that's very interesting. Now, would they be buying these through a brokerage firm, or how do they access them?
Yes, absolutely. So I think the best place to start a conversation around alternatives is to talk with a financial advisor, because a financial advisor, given the size of your portfolio or the amount of money you have saved, is going to be able to give you the best advice with respect to the types of alternative investments that are appropriate given your risk tolerances. And so many of these products are sold by financial advisors. And interestingly, financial advisors are really keen to educate clients on the use of alternatives, just as they've used estate planning or tax planning as a way to differentiate their wealth management practice. We see now in 2023, a lot of financial advisors are using education around alternatives to retain their best clients and to attract new clients.
Yeah, I can see why people would, want to do that. It would be an opportunity there. You talk about these alternative investments and emerging asset classes. You mentioned farmland. What are some of the other categories? What do you see as sort of the top emerging asset classes?
Right now, the net flows are going into private credit, and that could be direct lending, that could be structured credit. So the desire that investors have is for a high level of distribution or cash flow, and private credit really is quite interesting. I think last year we saw a correction in the real estate funds. Many investors invest in REITs, and with concerns around interest rates and rising leverage costs. So real estate had a correction. And so that's why we've seen more positive net flows into private credit. In addition to private credit, I would say that private equity, just given some of the correction that we've seen in that marketplace with valuation for private equity coming down, we've seen a lot of interest, people adding to their private equity exposure at these new lower valuation levels. I think that just like the demand for U.S. large cap public equity, I think there's a natural sort of extension into private equity. And individual investors have not been able to access private equity from the best sponsors. Some of these products make private equity more available now than it ever has been before. So it allows individual investors to invest earlier. As we know, public companies are staying private longer. And so a lot of that growth in terms of small and medium businesses is happening when these companies are remaining private. So private equity is a way to get individual investors access earlier and be able to participate in some of that wealth creation.
I think it's really interesting that you're explaining that, because I think a lot of people probably aren't aware of that. Now, when you look at these things, of course, the question that comes to mind is risk. And how do you assess the risk? And I suppose at the very far end of risk is things that are, venture into the fraud section, all the way through to things that are, just risky, and they're risky. how does somebody
Yes.
coming into this who's not an institutional investor, right, who's not someone who has all of those tools available to them, how do they look at that? How do they, weigh in the balance, so to speak?
Absolutely. So risk is first and foremost the main consideration before you would even allocate to anything alternative. There are trade-offs when you're investing in alternatives. The biggest risk that we talk about is liquidity risk. So the investment horizon that's appropriate for someone investing in private equity or venture capital, should be a medium to long-term investment horizon. If you need your capital and to access in the next 2 years, then being invested in mutual funds or ETF, which would provide liquidity, is more appropriate for what your goal is. And so having the right expectation and investment horizon and understanding that these investments, just like the purchase of a home, it's a long-term investment. You're not going to sell your home tomorrow. And if you did have to sell that asset tomorrow in a fire sale, you would expect that the price would be much lower. And so these illiquid or less liquid assets, you have to be very thoughtful with respect to the sale of the assets. And so liquidity is just one risk that we think about. Now, with respect to different asset classes, I talked about private credit and private equity being sort of popular, where a lot of investors are allocating in 2023. But the private credit funds, just as an example, many of them are using leverage. Many of them are using high degrees of leverage. And so you have to be comfortable with that. And so absolutely talk with your financial advisor about whether or not the risks are something that you can get comfortable with, because there is a risk return trade-off. The goal is higher returns, but with that, there are higher risks.
Right, absolutely. I think as long as people understand what the risks are, and then they can make their own decision, as you're saying, how much tolerance they have for risk, with regard to their own personal situation. So I think it's interesting that, you're mentioning that. When you look at these different alternative asset classes, and there seem to be a growing number, are there any that, in your opinion, stand out as, I don't want to say particularly attractive, but that you feel are becoming more important or more attractive for individual investors?
Yes, I think given the environment that we've been in the last 12 to 18 months, with not just higher interest rates, but higher inflation, I really am interested in real asset type products,
Right.
things like infrastructure or farmland, partly because they naturally benefit from an inflationary environment. Infrastructure, for example, contractually speaking, they have adjustments built into the contractual agreements, so that the investors in infrastructure are going to benefit to the extent that we do see inflationary pressures. And so I like the hedge in the portfolio that these real assets provide, particularly in an environment where investors may be pulling back from real estate, commercial real estate or residential real estate. I think considering farmland or infrastructure is an interesting complement to the portfolio, definitely for a long-term investor. But these are areas that are particularly interesting in an inflationary environment.
We're going to take a quick break now, and then we'll be right back.
We were hiring when we were making 50 to 100K monthly losses.
And why? Welcome to episode 1.
I can't think of a single founder who's been around for a decent amount of time in business who hasn't had their tunnel of year. This was that year. We're going to be okay, yeah, Sheree. Some are going to hear this and think, you TDP. But hear me out. You only have to do the math to understand that very soon we were $500,000 down.
Right. Yeah, I think that's a really good point, because you're talking about real assets, right? And I think that a lot of consumers, or individual investors, you might say, are nervous about things that, at least from their perspective, don't feel tangible. Do you know what I'm saying? It seems like almost like you're playing the shell game, so to speak. I mean, that's not a really,
Yes.
Obviously that's not a technical term, but people can understand if they're investing in, like you say, infrastructure or farmland or something that actually is there.
Yes, absolutely. And I think that the firms, I personally don't manage an infrastructure fund, but I like the way they illustrate the portfolio holdings. So you're talking about cell towers or windmills or, a plot of land in Oregon, that a certain sort of almond farm or apple farm. It's just, I think it really does help. When you think about contrasting infrastructure with private credit, it's hard for the mind to imagine, well, what's in a credit portfolio, and so I do think that investors, partly because of the experience that we all have, or many of us have as investors in our own homes, real estate is something that people can wrap their arms around. There's a sense of understanding, and I think that farmland and infrastructure are similar because they are tangible, as you say. So I think that as we don't want the word alternative to be a deterrent. One of my mentors had said, well, what does that really mean? It just means that it's going to, it's something else than U.S. stocks and bonds. And by diversifying the portfolio into a variety of different income producing or total return producing assets is going to benefit investors over time. And so that's all we're really talking about here, is sort of expanding, the diversification set, which hopefully is going to produce better returns for investors with lower risk over time.
Right, right. Yeah, I think that makes sense. Now, you also mentioned that investors need to rethink their traditional 60-40 stock bond portfolio, sort of the way it's always been done, kind of an approach. Can you talk a little bit about what you're seeing there?
Yes, I think, there are a few large asset managers that have suggested something more like, using alternatives as substitutes for stocks and bonds. So you take private credit and it could be a replacement for, a bond allocation. Private equity could be a replacement for U.S. Equity allocation. And so what the ultimate optimal asset allocation looks like is going to, differ based on client preferences and risks. But I would suggest that what we're seeing in the marketplace is, it used to be that alternatives would represent less than 5% of a client's portfolio. But now we're seeing the use of alternatives grow upwards of about 20%. Now, some clients are very comfortable with real estate, for example, so they may have a larger allocation to real estate. So I think the use of alternatives, there is this bucketing approach. I don't think that's actually how financial advisors think about it. I think what they look at is, how much liquidity do you need? Do you want all of your assets sitting in daily liquid mutual funds or daily liquid ETFs? Or do you have the ability to look out and take on some of this liquidity risk and diversify the portfolio? So maybe 15, 20, 25% of the portfolio could be earmarked for these types of higher returning alternative assets. And so that's the conversation that I think advisors are having now with clients about what's appropriate, what are people comfortable with. But we're seeing those alternative allocations grow tremendously. And so I think that the 60-40 is, as a concept, while convenient for kind of thinking about how we allocate, is probably out the window. And there isn't a industry model yet that has replaced it. But I'm sure Morningstar or other industry folks will come up with a clever way to kind of capture the essence of alternatives.
Right, right. Yeah, I think that's a good way to put it. Now, I guess the question that begs to be asked is, do you see any tie-in between alternatives and what companies are looking to do to add ESG touch points to their portfolios? I mean, maybe they have nothing to do with each other and there's no crossover, and that's fine. But do you see anything happening along there?
In the US, I think we've been slower to embrace ESG or impact investing. I think where we're seeing alternatives, and in the US, we're seeing more impact funds be developed. And I think there's also if you think about infrastructure investing, the approach that's sustainable over a longer period of time is naturally a more ESG driven approach. So the same is true with farmland. You want to leave the land better than you found it. So there's some alternative where ESG is just fundamentally part of the investment process. I would say from a product and marketing perspective, because there's sort of mixed views in the US with regard to ESG, there are fewer firms promoting ESG or impact in the US. In the UK, where we do some work, 100% of products that come to market, whether they're traditional or alternative, need to have ESG integrated, no questions about it. And then there's also a strong desire in the UK marketplace for things like biodiversity focused products or climate change oriented products. And I think that there is definitely there are US investors that are focused on that, but I think it's largely institutional investors funding those initiatives as opposed to demand coming from the retail investor.
Right. Yeah, I think that's really interesting. And, you make a good point about that Europe is far more along the line on that, right? There's much more development on that than in the US. So perhaps we'll see a little more growth in that area in the States.
I think we will. I'm hopeful if we leave politics out of it and we just think about the dynamic of where we're investing to solve some of the world's climate change issues. There's going to be a lot of innovation in that space, regardless of what your view is. And so if we're investing in new technologies that are going to solve some of those problems, I think that there will be US investor interest in that. There's a little bit of fatigue in the US given some of the greenwashing that we saw in ESG mutual funds. I think in some ways there was sort of US asset managers overbuilt for ESG, and there was a lot of rebranding. And so now that that's settling in, I think the truth there is that we are going to see a lot of interesting investment. And that's a climate tech and biodiversity investment is really an area that's exciting. And so I don't understand why US investors wouldn't want to take part in that. But that's why I think that the US institutional investors, some of the endowments and pension funds and family offices are actively investing. And I think eventually the individual investor will want to participate, but it's definitely early here in the US.
Right. Yeah, I think that's a very good point. Kim, you've shared so many interesting things with us, and I think a lot of people who are listening to this program would be very interested in being able to connect with you. They probably have a lot of their own questions, things that I haven't thought to ask. Where can people find you? How can people connect with you?
Sure. So we're here in Chicago. We'd love to connect. Our website is xainvestments.com. And please reach out. We've got a lot of resources on our website in our knowledge bank that talk about alternatives and ways to access them. So look forward to that dialogue.
Wonderful. I'm going to include all of those links in the show notes and certainly in the About section when this is on video platform. And you can certainly find those show notes over on our podcast website at www.seat.fm. So you'll be able to connect directly with Kim and ask what you need to ask and learn more about what she's doing. So Kim, thank you so much for joining us here today on A Seat at the Table.
Thank you, Jane. I appreciate it.